Hi there, welcome to GrainTV. I'm Kevin McNew. It's Monday, February 1st, and February started out the month much like most of January with choppy two-sided trade. Let's take a look at the Grain Edge trading platform and see where we closed. In Chicago, corn was down 1 cent a bushel, beans off 3, and wheat off 4. All of these numbers were better than where we were most of the trade session. Beans was off as much as 8 at one point, corn off as much as 4, and so we managed to actually push a little bit higher towards the end of the session. But overall, the market continues to struggle with direction. News today, the biggest driver in the global commodities market was crude oil, which lost $2 a barrel after last week's speculation that Saudi Arabia and Russia might reach some sort of output reduction deal. That news turned into not to be very likely as we started the week, and so crude oil took last week's gains and basically had a sell-off today, losing $2 a barrel. USDA's export inspections report was mostly neutral, with numbers coming in line with analyst expectations. So again, no bullish surprises there. The weather outlook in Argentina shows to be somewhat more favorable for rain in the 6 to 10 day outlook. The models continue to point to better chances of moisture as we get into the first part of next week. So that as well, which was a positive story last week, is turning into more of a neutral to bearish story this week. After the close, Egypt announced that they would be tendering for more wheat. This comes on top of the announcement over the weekend that they actually rejected a French cargo of wheat because it didn't meet specifications. There's a lot of speculation that we probably won't see much interest from suppliers because of the tight restrictions by Egypt on quality. So that'll be interesting to see. The other news out after the close today was the monthly USDA crushing number from USDA. They showed actual crushing for soybeans coming in at 167 million bushels. That's slightly below the expectations going in at 167.3, but within the line of analyst expectations of 166.5 to 168. So overall, it was a day of very little fundamental news to drive the market either lower or higher, and we continue to be stuck in this range-bound trade. Let's switch gears and talk a little bit more about what the US dollar means for grain exports. And in particular, we're at levels, as we look at this chart, the January US dollar index is the highest it's ever been since 2001, 2, and 3. So those years in particular, we saw exceptionally strong dollar as compared to where we're at today. Now, what's interesting about those years, those were years where USDA missed the mark on exports. They overestimated exports as of their January 1 report versus their final report. And that's sort of what we're thinking is going to happen this year. We're seeing exports really trail the pace that USDA has in store for us. The USDA currently has exports pegged at 1.7 billion bushels. I think they're going to be closer to about 1.5 billion bushels, or about a 12% drop. So that doesn't bode well for any sort of significant strength in the coming months. When we look at some of the other fundamental factors that were in play in those high dollar years, we can see U.S. stocks relative to use, range from 18.3% to 9.5%. This year, we're somewhere in the middle at 13%. But what scares me a little bit is the total foreign stocks relative to domestic consumption. That's a measure of how much corn there is in the rest of the world versus the U.S. And what you can see in this year, in particular, 2016, we're nearly at 25% of foreign stocks relative to total consumption. That compares to only 20% in 2002 and as low as 14% in 2001. So this year in particular, I'm concerned about the strength of the dollar, the slow pace of exports, and the abundant supplies in foreign hands that we haven't seen in previous years. So if you look at these 3 years in conjunction with what happened from January 1 to say May 1st, and look at the May corn futures over that time, and we benchmark this at January 1 being 100%, what you can see is we hardly ever traded above that, and we spent most of the time below it and ending, somewhere between 10 to 5% lower, as much as 15% lower in 2001. So, in my opinion, this doesn't bode well for those of you that are holding out for higher prices between now and the end of spring, I think it's going to be really problematic with the pace of exports where we're at, with the strength of the dollar. We did see the dollar back off a little bit, but overall the global economy is weak, and I think the dollar has continued to hold its strength, at least in the short run, and pose real problems for our U.S. export program. That's all we got today. If you've got any questions, give us a call, 877-472-4607, or visit us online at grainhedge.com to learn how we can help you in your grain marketing program.